Hey everyone, welcome back to the channel. Today I want to talk about the fairly recent news about Bill Hwang and his quasi-hedge fund, Archegos Capital. It was really a family office with his own personal wealth, not really a hedge fund, but he operated it much like a hedge fund. It's already being considered one of the most spectacular blow-ups in trading history, with Bill Hwang losing something close to $20 billion and a lot of investment banks and lenders losing a lot along the way. Now in this video, I'm not going to get into too many of the specific details around the Archegos Capital blow up, partly because it's already been covered by a number of channels on YouTube, including Patrick Boyle, that probably being my favorite breakdown. He does a lot of great finance content. I'll go ahead and include his breakdown of the Bill Hwang situation up above right now, but I want to focus on the leverage aspect of this, since Bill Hwang was able to amass an insane amount of leverage, and a lot of this was undisclosed, and it raises very concerning questions about the actual safety and security of the financial system. Because this was not some little Wall Street bets degenerate that lost a bunch of money really quickly, and it wasn't even a very big Wall Street bets degenerate who went out and lost a bunch of money. Instead, we're talking about an institutional level investor with billions and billions of dollars in liquidity who lost it all very quickly. And he did not have to take advantage of Robinhood's infinite margin hack to actually take advantage of this and blow up his account that way. Instead, he blew it up by just simply asking for it. Or at least that's what it would seem like on the surface, since there is quite a bit of missing information here. At least that's what it would seem like, because Bill Hwang did not invest directly into stocks most of the time. Instead, he used total return swaps, which are a derivative. So he'd basically sign a contract with an investment bank, a prime brokerage is what they're called here. I don't really know the technicals of how prime brokerages work, but we'll just say big bank. Big bank gives them a contract saying, yes, you are owed the returns and all the good stuff that comes with owning shares besides voting rights, but you don't actually own the stock. The bank owns it, but the bank is giving you all the profits from it. So it's like you own the stock, but you don't own the stock. You own the contract saying that you get the rights to the benefits of the stock. And one of the big benefits to the actual investor in doing this approach, when you get to the institutional level, normally when you buy stocks directly, you have to disclose what you're buying once you reach a certain threshold, which you'd probably reach when you're investing billions of dollars into any company or any set of companies. But because he wasn't buying the stock, he was buying swaps, he didn't have to disclose what exactly he was holding based on U.S. securities law. Hwang certainly valued privacy, so he did not buy the stocks directly, use these swaps, then he wouldn't have to disclose what he was holding. So his personal holdings within this quasi-hedge fund that was all his wealth would not be shared with the public, generally speaking. But it goes beyond the public, since Bill Hwang was using multiple banks here. So if he didn't disclose the swaps that he had with other banks, he could go to another brokerage or another big bank and ask for basically the same thing, for more leverage to do swaps, since he wouldn't have to disclose the holdings he already had, and he certainly could work around that. We're certainly waiting for details as to what each of these banks and prime brokerages actually knew, but there's a lot of speculation going around, and there's certainly a possibility that because he didn't have to disclose what he was actually buying, because he wasn't buying stocks, he was buying swaps on leverage from other brokerages, he could just keep doing this over and over with every brokerage that would lend him anything. And it's hard to say whether the banks really knew how much leverage they were getting him, since by current reports, it seems that he was 5 to 8 times leveraged, which is absolutely insane, on swaps, which were invested in stocks, so certainly very volatile in themselves. And Bill Hwang's portfolio apparently tends to be quite concentrated, so he'll put a lot of money into a few stocks, and you're going to see some volatility when you have that lack of diversity, since every stock could do a lot of different things in a short period of time, and that would certainly help him on the upside since he's leveraged, so his returns are dramatically higher. But because he's leveraged, it also hurts him more on the downside, and stocks do go down, unfortunately. And back to that leverage number, when I say 5 to 8 times leverage, what I mean is that for every dollar that he had invested in something, he had $5 to $8 of leverage thereafter in the same stock or maybe other holdings. But the way leverage generally works with stock holdings or derivatives and that sort of stuff is that if the value of the derivative or the security falls to a certain level, the broker or the lender will actually trigger what's called a margin call. And this is where the investor is actually forced to sell the asset. So theoretically, the brokerage would be safe since they're able to trigger the call, and that would protect them from all the downside, and they could pay back the loan and they wouldn't be underwater. But that is not what happened here, because stocks can move downward very quickly, and we have this amount of leverage. It doesn't take a huge move to actually trigger a negative margin call to where you actually don't have enough assets to cover the entire margin call if it happens. Generally, a margin call is going to be triggered when the value of the assets equals the amount of the actual debt outstanding. So when you're 100% leveraged basically. But in this case, as stocks like Viacom and others that Bill Hwang was invested in dropped, the leverage level went clearly above 100% because many of his lenders lost billions of dollars. To give you an example of the exposure that these lenders had, Archegos Capital, Bill Hwang's fund, was at about $100 million in holdings, but he only had something like $20 billion in net worth by late March when this margin call was triggered. So we're looking at about $80 billion in margin loans outstanding compared to the $20 billion in actual equity that Bill Hwang had. Using those simple numbers, all it would take would be about a 20% swing to the downside in a short period of time for the Archegos Capital fund to be underwater. And that certainly can and clearly did happen with a concentrated portfolio. I'm not saying that a concentrated portfolio is bad, but this is a huge risk when you have this amount of leverage involved in a volatile asset like stocks or the derivative of the stocks. As the stock values declined, banks started dumping all the stocks to cover the margin, which would cancel out the derivatives, of course. So Bill Hwang's fund quickly crashed down to zero, to where he had $20 billion just days before, down to zero, or really probably negative by the time everything was done. And the reason I say negative is because Credit Suisse has announced something like $5 billion in losses. Nomura Holdings faces $2 billion in losses, and there are other lenders involved who also lost money, probably looking at somewhere like $10 billion in losses to these big investment banks and lenders. But the most troubling thing with the Bill Hwang news and this whole situation with Archegos Capital is the fact that he was able to get all this leverage and no one knew about it, and no one in the public could actually tell what he was investing in with this amount of money, and it just raises concern that this is going on in other parts of the market. Derivatives can get very complex, and there are many layers to them. You can have derivatives of derivatives, options on more derivatives. Lots of things can really multiply the effect of a simple swing down in a stock price or some other security. And if this one guy got this amount of leverage and exposed these banks to that amount of losses, what else is going on behind the scenes that we don't know about? It just seems nuts that any one person or any company can get that amount of leverage just to play around in the stock market with. It just adds so much risk and certainly reduces confidence in the overall system if no one even knew about this well before it happened. But there's a chance that a lot of people did know that this was going on, which perhaps makes it even more concerning. But that's pretty much all I've got for today. Just wanted to talk about this leverage issue with the Bill Hwang situation and the lack of transparency that it exposes for potentially other problems in the financial system, especially with derivatives like these total return swaps. Who knows how frequently they're used and how much information is not being exposed. But if you like this video or found it informative, definitely like it, since that would help the channel out a lot. And be sure to subscribe, since I put out new videos every single week as they have to do with personal finance and investing, and that would help the channel out a lot as well. And until next time, take care.